Every major market crash in the last century has followed the same pattern. The world's smartest investors have made the same 3 trades before the crash. Most people get caught up in the euphoria, believing this time is different, ignoring warning signs. But a small, well-informed group sees the cycle for what it is and quietly repositions their portfolios. They aren't guessing, they're following a well-documented sequence of events. These 3 trades are designed to protect capital, preserve value, and profit from the downturn. In this video, I'll break down these trades, show how they played out in 1929, 1987, 2008, and why the same signals are flashing in 2025. Understanding this pattern is the key to navigating what's coming. The first trade is simple: convert to cash. It sounds almost too basic, but in times of excess, simplicity is often the wisest strategy. When the market is euphoric and everyone is chasing the next big win, the most experienced investors quietly step back, choosing safety over risk. They know that cash isn't just a placeholder. It's a shield, a strategic asset that gives you options when others are trapped. When asset prices are stretched by debt and speculation, the smartest investors shift from chasing returns to preserving capital. They recognize that the higher the market climbs on borrowed money and hype, the greater the risk of a sudden, sharp reversal. In these moments, the goal is not to maximize gains, but to minimize losses and protect what you've already earned. In 1929, Bernard Baruch and Jesse Livermore saw the warning signs: rampant margin debt, market leaders faltering, and quietly sold out, moving to cash. They didn't wait for the headlines or the panic. They acted early, understanding that the first to exit is the first to preserve their fortune. Their decision wasn't popular, but it was prescient. In 1987, George Soros recognized the unsustainable mix of rising rates, a strong dollar, and surging stocks. He reduced exposure, moving capital to cash. While others were swept up in the mania, Soros was preparing for the inevitable correction. His discipline allowed him to avoid the worst of the crash and positioned him to take advantage of opportunities that followed. In 2008, John Paulson saw the housing bubble and the risk in mortgage-backed securities. His first move: protect capital, increase cash. By stepping aside, while others doubled down, he not only avoided disaster, but was ready to act when the dust settled. This is the power of liquidity. It lets you survive the storm and seize the moment when others are forced to sell. Today in 2025, we see record debt, sky-high valuations, and speculative excess. The smart money is raising cash, selling profitable positions, and preparing for a correction. They're not trying to predict the exact top. They're simply refusing to risk everything when the odds are stacked against them. This is not fear, it's prudence. This move is often criticized as missing out, but it's not about timing the top. It's about avoiding the catastrophic fall. The pain of missing a few final gains is nothing compared to the devastation of losing half your wealth in a crash. Cash is patience, and patience is power. Institutional outflows into money market funds are rising, even as retail investors pile in at the top. The professionals are quietly building reserves, while the crowd is still celebrating. This divergence is a classic warning sign, one that repeats before every major downturn. Moving to cash protects you from the initial decline and gives you dry powder to buy when panic hits. When markets tumble and assets are on sale, only those with cash can take advantage. It's not just about defense, it's about being ready to play offense when the time is right. It's a disciplined, contrarian move, hard to make, but essential. It requires ignoring the noise, resisting the urge to follow the crowd, and trusting your analysis over your emotions. Most won't do it. That's why most lose. Without this step, the next 2 trades are impossible. You need liquidity to act when opportunity knocks. Cash is the foundation of every great investment play that follows a crash. You can't preserve or grow wealth if you lose it in the crash. The market always comes back, but not everyone does. Protecting your capital is the only way to ensure you're still in the game when the recovery begins. The first trade is being made right now. The question is, do you recognize it? Are you willing to step aside, even when it feels uncomfortable, to protect your future? Convert to cash. Preserve your capital. Prepare for what's next. The opportunity to buy low only comes to those who have the courage to sell high and wait. History shows this is always the right first move. The greatest fortunes are built not by those who ride every wave, but by those who know when to step back, hold cash, and wait for the tide to turn. After moving to cash, you face a new risk: currency devaluation. While cash can shield you from the immediate impact of a market crash, it exposes you to the slow erosion of your purchasing power. This is a risk that often goes unnoticed until it's too late, quietly eating away at your savings as the value of money declines. Crashes trigger money printing. Governments bail out, stimulate and inflate away debt, eroding the value of cash. When economies falter, central banks respond by flooding the system with new money, hoping to jumpstart growth. But this comes at a cost. Every new dollar printed makes the ones in your wallet worth a little less. The second trade: move a portion of cash into gold, a real asset that can't be printed. Gold has stood the test of time as a store of value, immune to the whims of policymakers and the printing press. It's tangible, finite, and universally recognized as a safe haven in times of uncertainty. Gold isn't for returns, it's insurance against currency debasement. Think of it as a financial fire extinguisher, something you hope you never need, but are grateful to have when disaster strikes. It's not about chasing gains, but about preserving what you've already earned. In 1933, Roosevelt devalued the dollar overnight. With a single decision, the government changed the rules, and those holding cash saw their wealth shrink in real terms. It was a stark reminder that the value of money is not set in stone. Gold holders preserved wealth, cash holders lost purchasing power. Those who had diversified into gold weathered the storm, while others watched their savings lose value almost instantly. In the 1970s, after the US left the gold standard, inflation soared and gold skyrocketed. The dollar weakened, prices surged, and gold became a lifeline for those seeking stability. It wasn't just a hedge, it was a lifeboat in a sea of uncertainty. After 2008, central banks printed trillions. The response to the financial crisis was unprecedented, with governments around the world unleashing waves of stimulus and quantitative easing. The result? A flood of new money chasing the same goods and services. Gold doubled as investors hedged against devaluation. As confidence in fiat currencies wavered, demand for gold surged, driving prices to new highs and rewarding those who had prepared in advance. Today, with record global debt and central banks ready to print at the first sign of crisis, the risk of currency devaluation is higher than ever. The world is awash in debt, and the tools used to manage past crises are now the default response, making future devaluations almost inevitable. Central banks themselves are buying gold at record pace, diversifying away from the dollar. They understand the risks and are quietly preparing for a world where fiat currencies may not hold their value. Gold is not speculation, it's protection. It's a shield against the unknown, a way to safeguard your wealth when the rules of the game suddenly change. Allocate a portion of your capital to gold or gold-backed ETFs. Even a small allocation can make a significant difference when markets are in turmoil and currencies are under threat. Cash protects you from the crash. Gold protects you from what comes after. It's about building resilience into your portfolio, so you're prepared for both the shock and the aftermath. The pattern is clear. Debt bubble, crash, money printing, currency devaluation. Gold is the hedge. History doesn't repeat exactly, but it often rhymes. And the smart money knows how to read the signs. Don't wait for headlines. Position before the crisis. The best time to act is before everyone else sees the writing on the wall. This is the second trade the smart money always makes. In a world of uncertainty, gold remains the timeless answer for those who want to protect what matters most. The first two trades are defensive, designed to shield your portfolio from the worst effects of a market downturn. They're about survival, preserving capital, staying liquid, and weathering the storm. The third is offensive. This is where you flip the script and aim to profit directly from the crash itself, turning fear into opportunity. In a crisis, volatility explodes. Markets swing wildly, prices gap up and down, and uncertainty reigns. This chaos is terrifying for most, but for the prepared, it's a moment of rare potential. By betting on this volatility, you can generate extraordinary returns, sometimes in days or even hours. The bigger the panic, the greater the opportunity for those who know how to position themselves. History is full of examples. In 1929, Jesse Livermore shorted leading stocks as panic set in, earning a fortune while others lost everything. He saw the signs, acted boldly, and became a legend. In 1987, Paul Tudor Jones used index futures to short the S&P 500, profiting massively on Black Monday. He anticipated the crash, placed his bets, and reaped the rewards as markets collapsed. In 2008, John Paulson bought credit default swaps on subprime mortgages, turning a global financial crisis into billions in profit. These investors didn't just survive, they thrived. Today, you have more tools than ever before. Put options on major indices, VIX calls, and volatility-linked ETFs are all accessible to individual investors. Technology has leveled the playing field, letting you execute sophisticated trades from your laptop or phone. Put options let you profit as markets fall. You pay a premium, and if the market drops, the value of your option can soar. Your risk is limited to the premium, but the upside is huge in a crash, sometimes delivering returns of several 100%. The VIX, often called the fear index, surges when panic hits. It measures expected volatility in the market, and when fear takes over, the VIX can spike to levels rarely seen in normal times. Buying VIX calls or volatility ETFs is a direct bet on this surge. When everyone else is running for the exits, these instruments can deliver outsized gains in a matter of days. The key is asymmetry. Small bets, big potential rewards. You don't need to risk much to potentially make a life-changing return. This is the power of asymmetric trades. Allocate a small portion, just 1 to 2% of your portfolio, to these trades. This way you're not overexposed, but you're ready if the market unravels in a crash. These positions can offset losses elsewhere and even create new wealth. They act as a hedge, but also as a source of potential windfall profits. This trade requires conviction and timing. You need to be patient, waiting for the right moment, and then act decisively when the signals align. But it's the culmination of the process, the final step after you've protected your capital and positioned yourself for opportunity. You move to cash protected with gold, and now you're ready to take advantage of the chaos that others fear. Now you're positioned to benefit from chaos, standing calm while others panic. The next crash will offer abundant opportunities: overvalued tech stocks, zombie companies on the brink, even sovereign debt crises. The landscape will be littered with bargains for those who are ready and willing to act against the crowd. When others panic, you're prepared. You have a plan, and you're ready to execute it while others are frozen by fear. Your volatility bets pay off as others scramble to make sense of the chaos. This is where preparation meets opportunity. This is the ultimate transfer of wealth, from the unprepared to the prepared. Those who saw the signs and acted decisively are rewarded. The third trade turns crisis into opportunity. In the end, it's not just about surviving the storm, it's about thriving in it and coming out stronger on the other side. These three traits aren't secret, they're a historical pattern. Debt bubbles, crashes, money printing, and volatility repeat because human nature doesn't change. The only question: will you recognize the pattern and act, or ignore it and watch your wealth evaporate? It's not about predicting the day, it's about seeing the season. The signs are everywhere: record debt, speculative excess, market highs diverging from reality. Most will be caught by surprise. You don't have to be. Prepare now. When the crash comes, it's too late. The transfer of wealth will have already begun.